All right, welcome back to Two Stupid Guys Trade Stocks. I'm Vinny,
I'm Dylan.
and today we're going to talk about my next value pick in the series. It's something that help exfoliate your skin there, Dylan, if you're so inclined, living down there in that Arizona sun.
Hey, dermatology is well and alive because of that sun. So
I know, right? Like, did you guys carry you got to start adding some new skin products to your office, maybe.
Probably not. Yeah, we're worse.
All right.
If
So
you guys are watching, sorry. If you
Yeah.
guys are watching the previous video, new skin was on a swing trade opportunity, and if for the 14 people that watched it, we got a great buy-in entry, and it's looking really good. So now it's a value pick. Look what happened.
I know, right? Like I was digging into the finances here, and I was kind of blown away a little bit. So New Skin Enterprises, they're a multi-level marketing company selling skincare products under several different brand names. I think that one of the more commonly known was Age LOC, Age Lock. But anyways, they're pretty broadly diversified. They're a global company. They've been around for a long time. I want to say 1993, somewhere in that ballpark. They're not new at all. They've been profitable for quite a while, growing in Asia and the United States still. In Europe, they're kind of doing well across the board. Here's kind of a recent, this is a 1 year graph of them. If you notice, this is a massive pullback down here. That's after earnings. So I like to screen for largest percentage loss companies. And this is kind of where we first encountered this company was that they had a pretty precipitous drop there after earnings. So you would think that they completely missed earnings based on that graph, right?
They did not.
Yeah, they did not. They missed on revenue by about 1.5 million. However, they beat on the bottom line pretty noticeably. And then the other kind of concern that came out of the most recent quarterly report was that their gross margins had contracted a little bit. I want to say they were about 70% gross profit margin, whereas they had been 74 previously. I forget exactly how long ago that was, but definitely some contraction there. But they're still so profitable that I was very impressed. And if you notice here along the bottom, see all these little D's? Those are actually dividend payments. So this is actually a dividend paying company. That's always a good sign of stability, at least in my book.
Absolutely, it is.
Yeah. So this is from FinViz. This is kind of a quick snapshot of their earnings and finances here. You notice that forward PE of 12 is pretty good number.
The share float is the credible part here. A PE of 12 and they only have 50 million float. Yeah. Apple's like 3 billion or something. Yeah, it's a lot. But this is not a big float stock. This is a small company.
Yeah, it is a small company. Market cap's about 2.5 billion. Yeah, 2.5 billion. So a relatively small company. It's easier to grow a small amount of money than it is a large amount of money, and they're doing pretty well as far as I'm concerned there. They're not going crazy in acquisitions. They're very well capitalized. If you look at the current ratio, I don't believe that's actually correct. I'll talk about that again in a minute here. They don't have really a ton of debt on their balance sheet. You look at the earnings per share growth. Yeah, it was 17% last year. That's a little bit above what they had previously been seeing, but they're a good 6 to 7% or so earnings per share growth kind of company. Like I said, very well capitalized, pretty inexpensive today. If you look at, this is from their investor day presentation, they significantly grew the number of active customers last year. This is the kind of product where you're frequently repurchasing the same product if you're happy with it. So growing your active customer base, I think, is really important. And they allow kind of set up these small e-commerce websites. So over 90% of their sales last year came from online, which is I think the way to go these days. They're not reliant on in-person parties or any sort of stuff or meetings.
They're definitely adapting for sure.
Exactly. Yeah. So they're able to compete. So a quick snapshot of their finances from last year. They were able to grow, like I said, their earnings per share by 17%, but they had 7% revenue growth as well. So that 17% earnings per share growth is not something that can maintain for a long period of time. But I consistently growing in the 7 to 10% range as far as revenue, both top and bottom line, I think is very reasonable for Nu Skin. So a couple more highlights. So like 7% year over year growth. They had some new product launches that they were pretty happy with the outcomes thereof. They were able to improve the earnings per share by 17% based on some cost reductions and also some share repurchases. We talked a little bit about that in my Warren Buffett video. Share repurchases are great. That's a nice way for companies to give back to shareholders because it's immediately accretive to the shareholder. Companies are often tempted to go on these acquisition sprees with shareholder value rather than reward the current shareholders, and I think Nu Skin management gets it. They both pay a dividend and then they repurchase shares, and they also pay down some debt, but they're not a particularly debt heavy company anyways, so but they use their cash flow appropriately. So they increased their dividend for the 20th year. That's quite an important feat. I think one of our new subscribers would be quite happy to hear that one. Some people love dividend. This is yielding right now about a 3% dividend yield.
To speak on the share repurchases, I'll show you on the graph, but they've been kind of chilling around for 2020. Honestly, around the $30 to $45 range, and they're at 51 now. So the share repurchase price would have been a very solid price where they're buying more at what they think is cheap, and we're not that far ahead of that. So it's a pretty good time to buy.
Yeah, very much so. You just gotta have to go ahead and share that with me. So this was kind of what they're planning on doing with their 2020 cash flow. They're expecting to have about $350 million in cash from operations there, spending a little bit of money on capital expansion stuff. They've actually started manufacturing so that they produce products for other skincare lines. So they're going to spend a little bit of money on building that out as well. Pay down some debt, nothing too crazy, and then they're going to continue paying the dividend. They did announce a dividend increase for this year. All right, like I said, they're kind of really pushing that share repurchases most since 2003, which is something I very much enjoy to see that as a shareholder.
That's wild.
Yeah. So projections for next year, you're talking about another $2.7 billion or so in revenue, which gives them a price to sales ratio of less than 1 right now because they're at about a $2.5 billion market cap. Operating margin 10%, and then earnings per share you're talking about $3.80 to $4. So this is a company that's looking at like at least a PE of 12 next year at the current market price, which is just insane to me.
Especially for the float. That's wild.
Yeah. It's like a 25 PEs where the whole S&P is at right now. Yeah. So pretty value oriented company here. There's a little chart of that dividend growth we were talking about for 20 years straight of dividend growth. Very, very impressive, and they're still very conservative. You're talking about $78 million in dividends on a $350 million cash flow. So you're talking about a 25-30% kind of basically payout ratio there. So this is not a dividend that's going to cost them their ability to grow their business and that sort of thing, but it's still a solid yield at 3%.
So the big increase from I think it was 2012 to 2013, their all-time high was in 2013. It was $138 for the stock.
Always good to know. Yeah, it's pretty crazy. I mean, I'm not surprised though. I guess I was talking about the current ratio. So the current ratio is the current assets divided by the current liabilities, and they're only at a 0.6 ratio, meaning that if they had to pay off all their debt right now, they're able to meet that. Less than 1 is what you ideally look for in a company as far as safety. They repurchased about 6% of the company back in 2020, which is, like I said, it's a great thing. By me owning shares and them repurchasing 6% of the company, basically I am getting an extra 6% of it for the same price, which is awesome. And then the 2.99% dividend yield, which is great. And I love earning 3% or so as I wait. It's better than any high interest deal checking account out there. So I did some discounted cash flow pricing for this stock right now. And assuming about a 10%, which is kind of in the middle of their range as far as what they expected for next year. They gave a 7 to 13% range. I'm sorry, I think it was a 5 to 13% range, and then slowing down to 5% or so a year. It gave me a $94 like target share price right now. That's 80% above where it currently trades. It's a little aggressive. I also did it with a 7% growth, which is kind of more in line with the revenue. And even at that point, we're still looking at it was a greater than $80 kind of share price at this point in time. And this final note is a very bullish sign to me that a couple of insiders have purchased almost 41,000 shares over the last 10 days in this high 40, around $50 price range. When insiders purchase a stock, that is a good sign to me. They say, insiders may sell a stock for many reasons, but they only purchase it for one reason, and that's because they think it's going up.
Right. And just to throw that again, 41,000 shares may not sound like a lot, but when the float's 50 million, that's pretty good.
Yeah.
It's at least 0.1% off of just one day.
Yeah, exactly.
That's pretty wild.
That was this chart here.
So this is the 200 moving average here. So this is the drop that happened after earnings. That was kind of shocking, especially with how good they did. So basically, during the swing trade video, I think it was, I recommended the buy here or here, but it was at 47. So oftentimes a stock will use this as a support, kind of bounce around it. And as you can see right now, we have a bullish signal. That's what happens when sellers were trying to sell it down and it just didn't work, went back up on increased volume. So we're looking at a little bit of a breakout here. The last time that this stock dropped a lot was in November, and it also came right back up within 2 days. So I'm thinking this is going to go up pretty fast here, and I need it to because I have $50 calls. So expired March 19th.
Yeah. Yeah, I think you got a good shot at that. We'll see how it goes.
No, I have a lot riding on it. So
yeah, I think I picked up 100 shares is what I did. So
I also got 100 shares.
Oh,
I did that and the calls.
Well, getting fancy. All right.
I'm cost average at 47 for the 100 shares.
Yeah, that's awesome. All right. Well, thank you for joining us again, and we look forward to having you guys again next time.
All right. Have a good one.